Morning, all. Another day in paradise. Thursday, July 21, and the beat goes on. So you're saying there's a chance. It's remarkable. Jesse Felder had a good piece just, I think it was yesterday. Something to the effect that you would have thought after all the destruction the markets have seen in the last year or so that speculation would die. But no, no, no. The dream endures. And the market's schizophrenic. One day, one week, it's going to zero, get me out. And then when it reverses course and heads up, so you're saying there's a chance. I don't pretend to be able to call these short-term wiggles and jiggles. It's not what we do. I don't like engaging in picks. We're trying to get the big picture right. I think we've done a pretty good job of that. Never a dull moment. And we've got a great room today. The esteemed Walter Deemer, really a treasure. Been around, been in the locker room with some of the greats. Long time strategy technician at Putnam. Worked across the street from me, my Fidelity days. Worked with Bob Farrell, and actually, Walter. One of the good things is, we'll talk about markets and everything, but when we get to the discussion, I think it might be a good thing to talk about. Who were some of the people that impacted you earlier in your career, and some of the all-time greats that you met, because you're kind of a bridge to another time and another place, and there's a tremendous amount of wisdom that emanates from those eras. It's been lost, I think, on the public, and we really, really will benefit enormously from your wisdom. A couple comments on the market. You know, Thornton again nailed it. Counter turn rally. He's good at it. Clearly a bottom, but not the bottom. And we've talked about it many times. And you're gonna have to come up here because you need to talk about this. I keep trying to channel my inner John Roque, reminding people of that great study you did of the 2000 bear market, 2000 to 2002 bear market, where despite the market falling 80% over 2.5 years and decline, and it was up 47 days, if I got the numbers right, you were 10 counter trend rallies in excess of 15%, and 15 counter trend rallies in excess of 10%. And, counter trend rallies, they're not a bug, they're a feature of bear markets, just to keep people in the pool. So, in any event, we got another one of these rallies on our hands. I personally believe it's just another counter trend rally. Where it peaks, anybody's guess. I just scratched a couple points here in preparation for this, talking points. Earnings, for those of you that pay attention at home, as Michael Belkin was saying in the drum on most loudly, earnings are falling. Earnings are down in the first quarter. Earnings are now falling in the second quarter. Particularly if you strip out energy, earnings ex energy are going down. So it's not like we have to theorize they may go down. They are going down. And this is before, whether we're in a recession or not, who knows? But this is before we get into a real big recession. And as the great Michael Kantrowitz has been in this room many a time, explaining to us how the market's unlikely to bottom for a year. So the party's just getting started. The band just showed up, and you already have earnings going down. And the Fed's hardly begun to shrink the balance sheet. So declining earnings, declining liquidity, the great Michael Howell. I mean, it's just amazing. You get so many wonderful people coming in these rooms sharing their wisdom with us. You put the pieces together, and it's like I think the market's going a lot lower. Whether the high was yesterday or the high is not going to be in September, that's my deeply held view. I could be wrong. Won't be the first time. Won't be the last time. Two other points I want to mention. And by the way, if any of you are interested, I did put a deck of slides together. If you're interested in getting that deck, please send a direct message to either myself or to my colleague Carol Strone at Carol Strone. You need to give us your email address. Otherwise, we can't send it to you. We don't know where to send it. So I sent one out, I don't know, 6 weeks ago. It was pretty well received. It's like 100 slides in there that might be of interest. At any rate, one of the other topics, two other topics I want to touch on before we get to Walter. We had Ivy Zellman, who just knocked the ball out of the park last Thursday. That has to be, I think, the most widely listened to space that I've yet done. Between 25,000 Twitter listeners and a few thousand more on YouTube. Be sure to subscribe to our YouTube channel, by the way. God, I sound like I'm so commercial now. I'm getting good at this. all the YouTube video, all the spaces from like mid-February are on there in chronological order. We missed a few prior to that. We didn't record that. They disappeared from Twitter before we could put them up on YouTube. But if you want to go back and listen to some of those spaces, some of those are timeless. They've got nothing to do with where the market was or is. They're just timeless. Stan Weinstein is an example. We hope to get Stan back sometime in the future. But Ivy last week, what blew me out of the water, I guess, two observations. One, this is really a key takeaway for me. The 24% of housing transactions involve a non-primary buyer. That is to say, someone who's not living in the house, whether it's a financial buyer like a Blackstone or someone putting up a house by built to rent or Airbnb. I'm sure all of us know someone who's now become a hotelier. They buy a house and they say, oh, no problem. I'm going to rent this thing out and I'm going to make money in a positive carry. Point of all that is, yes, we do not have a emerging crisis in mortgage-backed securities a la 2008. History rhymes, doesn't repeat itself. However, we never had this much non-primary activity, meaning that these buyers, these 24% that are non-primary, they're financially motivated. And the other point aligned with that, Ivy was pointing out how the information comes in a much more timely fashion in terms of pricing. You can go on Zillow, Redfin, all the rest. So that I think the fact you have such large secondary supply, this concerns supply and prices turn down as they have. I think could really shock people the speed with which the housing market falls apart. That's my personal opinion, but I think what's happening. And Ivy actually cited some of the cancellation rates that are occurring now in some markets, some of the most overheated markets. I believe it was Phoenix, where she said it was up to 35% now or something like that. I think in the last cycle, it was up to 55%. So the housing market's turning down. I have a great slide in the deck which shows the extent to which housing inventory, houses for sale that are on the market, is skyrocketing right now in various markets. And predictably, it's been the most overheated markets out west, places like Arizona and California, where you're seeing the biggest surge in inventory. So I think the housing market's falling apart. And now
Hey, George.
Kantrowitz, it's extraordinary. All these people have been in these rooms are regulars, are friends of the room. Michael Kantrowitz explaining how this sort of hope methodology, where all kind of starts with housing and trickles through in terms of ISM, the economy, earnings, et cetera, et cetera. So the party's just getting started with the earnings downgrades. And you combine that with liquidity, I just think the market's going much lower, much lower. And the last thing I'll say,
George
Bianco, he had some comments the other day talking about the likely course of inflation from here. He's been in these rooms. He remind everybody the year ago time period, July, August, September, the easy comps, that is to say, inflation was very low in those months. So even if you think inflation's peaking now, has peaked, two things. A, keep in mind you've got easy comps for the year ago period. So the inflation numbers are still going to look pretty bad for July, August, September. And then more importantly, the issue is not has inflation peaked. The people who frame that argument are the same ones who said it was transitory. Run, do not walk from anyone who says that. These people have no credibility at all. I don't see why you listen to anything they say. The real issue is, as Jim Bianco frames it, is how quickly will inflation come down? If inflation is 6 or 7% by December, even if they raise 175, and you get a Fed funds rate of 350 or whatever it is, rates are too low. Rates are too low. And so I don't see the Fed adding liquidity to the system anytime soon. So you have liquidity news tightening combined with collapsing earnings. I don't know. Maybe the market goes up. Stranger things have happened. Sorry to be so left brain dominant and logical, but that's my 2 cents. All right, let's go to Walter. So, Walter, I'm really, really glad that you are with us today. I know you were challenged technologically, like some of us were for a while. I was trying forever to get you to come in the room, and you were like, well, I can't figure out how to do this, and I got on my desktop, I got on my cell phone. So, congratulations, Walter. And by the way, I just want to let you know you're in good company. You're not the only person who's had this difficulty. So, I'm absolutely thrilled that you're with us today. And so I don't know how you want to do this, Walter. Maybe just talk about, maybe your views on the market, what you have high conviction about, what you find interesting, what you find noteworthy. So, Walter, over to you.
So, Walter, I'm really thrilled that you're here.
you're a wealth of experience, and you've seen so many market cycles. Maybe you could start off by just what sort of captures your attention. What do you think about what do you find interesting? So Walter, take it away. The floor is yours, Walter.
Okay. Make sure you can
Yeah,
hear
we
me.
got you, Walter. My bad before.
Okay, that's okay. Okay, I'm Walter Deemer. I've been around for a while. I started working for Bob Farrell in 1964, and I was in a boardroom at State College, Pennsylvania during the crash of '62, where I learned more in a week than I did in 4 years on campus. So, I've been around. Whether I've learned anything from all that, I don't know. But a couple of comments. Number one, that George mentioned the ARC. That one day I was looking at the market, and the market was going down. And I wanted to see how much ARC had collapsed, and it didn't. And I said, well, that's strange. It usually leads on the way down. So I started watching it, and it didn't seem to be leading the market down anymore. And then it started actually generating some relative strength. So I said, if the biggest leader on the downside is starting to generate relative strength, maybe that means it's okay for the market. Now, which does not mean you rush out and buy ARC. I just use it as a bellwether. I think, as George mentioned, John Roque had a terrific thing about how many uh, rallies there were when the dot-com bubble collapsed in 2000 for the next couple of years. And you can't even find charts to see how things rallied because the things that collapsed went out of business and there are no charts on them anymore. So unfortunately, when I moved, I donated all my old chart books to the MTA library, so I can't look them up. But there were a lot of rallies in there as stocks went from over 100 to zero in chapter 11. Uh, so you do get rallies, and I thought ARC might have been a bellwether. It might still be a bellwether, which doesn't mean it's a screaming buy. That I get the idea that an awful lot of people want to call a new bull market really quickly. That the market does something good for a couple of days, and everybody says, "Oh, we're in a new bull market." And I wonder, maybe the market isn't going to make a V bottom. Maybe it's not going to go straight up like people would like it to. Maybe it's going to go down and get wherever it's going, and then maybe it's going sideways for a while. And in the old days, the market went down, built a base, and went back up. So went back and forth, and it frustrated everybody. Everybody jumped on the rallies, and they got frustrated. And finally, the market told them that rallies weren't new bull markets, and then all of a sudden, one of the rallies was a bull market. So, maybe what frustrates people is it doesn't go up a whole lot and make a new bull market. But when it stops going down, maybe it rather than going up, maybe it goes sideways for a while. And um, one of the thoughts is that there's traditionally the market launches a very powerful advance 3 months before the end of the recession. And so all you need to ask your economic friends when they come down from their ivory tower, ask them to tell you 4 months before the end of the recession that the recession is going to end, because then you have a month to buy stocks and then enjoy the rally. So that's why I think that with the Fed in a tightening cycle and the economy in a recession, um, maybe it's not ready to go up yet. Yeah, maybe it'll stop going down and go up. Maybe it keeps going down. I don't know. I don't know where the low is. I mean, I have no idea. There's and the market can go down anywhere it wants. Um, and I think the big question is whether something breaks, and whether that's something in Europe or something in Japan or something in the United States. But you all know the pressures that are in the financial system, and the question is whether something breaks or not. So um, I think the only message I leave you is when the time comes to reshort, you won't want to.
Just like Walter, when it comes time to buy, you won't want. And Walter, you talk about leaving a mark. I quote you all the time. I urge everyone to go to Walter's Twitter feed and go on his website. He has a delightful book, a short little book, it's a compendium of a lot of great quotes from all-time market greats. Some of them are original on his, others just a compilation of others. And Walter, I truly find it an inspiration. I have to tell you, every month or so, I pick it up and I flip through it. It just reminds me of how little I know and how uncertain the world is. Um, and I don't know if you were still doing this professionally. One of the great lines that I use all the time now. It's not an original of mine. It came from someone else. I can't remember whom, but I keep saying, "I'm not young enough to know everything." I repeat, I'm not young enough to know everything.
Yeah.
And that's actually, let me ask you something, Walter, on a serious note, jumping off of that quote. Um, there's nothing new under the sun. Fear and greed, speculation, wash, rinse, repeat. We change the names of the players, but the game's always the same. However, um, how do you, being sort of a market psychologist, how do you think about the fact that in this post-great financial crisis environment, we've had, this extended upcycle, leaving COVID out for a second, which is really kind of a mistake. Just put your finger over the chart there, and the Feds came in and made sure you recouped all the losses that you had. But essentially, we've had this, lowest interest rates in recorded history, which has given us the most excessive valuations in history, most widespread public participation. And and I want Shrub to weigh on this in a few minutes. And so when you think about how they've all been conditioned in Pavlovian style to just buy the dip and not sell. Don't worry, it'll come back. Stocks for the long term, 60-40. Jeremy Siegel, please call your office, blah, blah, blah. And, Mr. Markets taught them the lesson to keep buying every time it goes down. And then one day, it's like the little boy that cried wolf. In this case, it's because of inflation. And so from my small perch where I sit, but I'm appealing to you because you've forgotten more than I'll ever know. How do you think about the effect of market psychology when you've had this big, long, drawn-out upswing? It just strikes me it takes a while for market psychology to change. And therefore, people will react to these declines differently than, say, they would have reacted to a similar decline maybe 10 years ago. So how do you think about the market regime that you're in and how it impacts market psychology, Walter?
Well, the first thing I'm going to say is I don't think human nature has changed, so I don't think psychology has changed. I mean, I know there are a lot of machines involved, but human nature doesn't change. The market goes down, you think something's going wrong, and the market goes up, and you think everything's right. Our wives are probably better than market analysts than we are, because when a pair of shoes goes from $80 to $50. They go out and buy it. They think it's a steal. If the stock goes from 80 to 50, we say, what's wrong with it? So, psychology hasn't changed.
That's brilliant, Walter. 100%.
I mean, psychology hasn't changed. But, I think, as I say, I think the thing that intrigues me is that, the market starts back up, and then everybody starts jumping all over the fact that a new bull market has begun. Like, for instance, there was a study out of Jason Gofford of Sentiment Trader put out a study that's been widely quoted that 2 big up days within 3 days, without a down day in between, leads to higher prices a year from now, which is all well and good. But all that's saying is that the S&P is going to be above 39.50 a year from now. But how it gets there, you don't know. And if you go back and look, there was some 20+% drawdowns on the way in some of them. So, yes, it was higher a year later, but, you didn't go there. You didn't go straight up for the year.
100%.
And everybody looks at that and they say, oh, good, we got a green light for the next year. Not true.
Yeah, and also you got to consider context, because in similar fashion, I'm sure you've seen the same charts that I've seen, Walter. You pull out some of these Ned Davis charts or whatever, it's all the same stuff. And they say, well, every time the market's gone down 25% and consumer sentiment is bad and blah, 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 8 out of the last 9 times the market's gone up on an average return of 27%, blah, blah, blah. But what's interesting is you look at all those past times. Now I'm going to try to put some of the fundamentals on top of it. At each of those lows, you were in the depths of recession, and the Fed started pumping like crazy. The context is completely different. You got the market down, the recession's just getting started, and the Fed is hell bent on putting their foot on the accelerator on the tightening. So I just think, people badly. Walter, you're a pro, so it must make you cringe sometimes. You see people misusing sentiment. They misuse technical analysis. You get your crayons and a ruler out, and people know 0.618 and there's Fibonacci, this and that. And there's so much amateur hour stuff going on. I just, it's I hear the term democratization of finance. So it's, oh, no problem. Hey, I got a ruler and crayons. Yeah, Deemer does that nice. I can do it too. So, I mean, Walter, I guess my frustration under all that about all that is, how would you comment on some of the analysis, if you can call it that, it's being charitable, analysis that you see in the public square on Twitter and elsewhere? I mean, back in the day, it was more the purview of the pros like you. And I don't mean to make it an egalitarian thing, but I see a lot of amateur stuff, and I just find it truly cringe. And I'm just sort of curious: do you see a lot of misapplication of technical analysis, or technical analysis that makes little sense to you these days?
Yes, that's why I use the mute button on Twitter a whole lot. If somebody comes out with opinions and doesn't back it up with anything, or they back it up with something screwy, I just mute them.
It's funny. You see that on the technical side. You see it on the fundamental side as well. I mean, and I think come back to this term democratization of finance. Yeah, it's all well and good to empower people so they can make their own decisions, but it's like anything. You got to put the time in. You got to put the work in to know what you're doing. And I think individual investors are just blowing themselves up by thinking they, don't worry, I can do this at home, no problem, I got this. I watched the YouTube video. Oh, okay. Or you sign up for one of these trading rooms, $99 a month with a Discord service, and you got some Yahoo with a baseball cap on backwards saying, "Hey, bro, what's going up?" I mean, it's just this is going to end very, very badly. Walter, could you speak to the public has hardly sold anything. If you look at, we had last year, it was $1 trillion. And Shrub, you got to get in here. We had was over $1 trillion or $1.2 trillion of inflows into funds. This money has net come in this year despite the schmeicing of the market. Kathy Wood's getting money in, et cetera, et cetera, et cetera. So when you see the public still holding the line, in fact, adding in the face of a decline like this, how do you react to that? What does that tell you, Walter?
It tells me the public has some learning to do. And the thing that I find interesting is all of a sudden there are alternatives. I mean, I live in a senior living community, and it's upscale, and the people here are more successful investors than I am. But they're all looking at interest rates, and they're starting to get interested in the fact that you can now get like almost 2.5% on a 90-day T-bill. So there is an alternative. No, it won't keep up with inflation, but plus 2.5% is better than a minus in the stock in equities.
Yeah, I keep saying when I'm in my rants, I go, Tina is dead, FOMO is dead. Tina is dead. And there's a great, again, if anyone wants the deck, it's one of the charts. I basically just steal stuff off of Twitter, but people want the curation. There's a great one which I'll put it up in the nest. Actually, it shows the number of stocks in the S&P that are yielding more than bonds. And it was a big number before because bonds yielded nothing, and now it's a little number. I know some people say, "Well, George, that doesn't include the stock buybacks, so that's a form of return to investors as well." But just ignoring that, I mean, there is an alternative now. There is an alternative, and I think you're totally right. So Walter, you say so they've got more education to do here. So what does that mean to you? We haven't seen the low in the market yet. Like put some meat on those bones, please.
Well, I don't know whether we've seen the low, but we haven't seen the new bull market start. As I say, the thing that intrigues me is that maybe rather than going straight down into oblivion, which is still a risk, maybe we go sideways for a while. I mean, the thing that would frustrate a lot of people, I suspect, is if the market goes sideways for 6 months, 12 months, something like that. As I say, until the market senses the end of the recession, and as you say, the Fed doesn't have a magic bullet this time, so that they can't come to the rescue. Not yet. I mean, no, and they're not going to.
Yeah, that would just really frustrate everybody if the market just did nothing. It would frustrate, the growth guys who are just, they're pure momentum players and they need more liquidity to make money. They'll just start bailing eventually, and then the guys who are short, the wise guys like me, will get frustrated because we're not making money on the short side. Just everyone gets pissed off, and maybe we get apathy and volume just trickles off. Usually, at the bottom, like nobody really. Don't you have to have like apathy, dejection, depression, fear, and loathing at bottoms. I mean, maybe it doesn't get that dire, but when the markets don't bottom, when people are jumping on every rally to say, "Oh, it's here again." I mean, the lessons shall be presented and shall learn. So, I mean, just behaviorally, don't you think we're not? I mean, I guess what you're saying, Walter, is it could be a bear market in time, not price. But would you agree that this is not the bottom, though?
Yeah, it's not the time. It's not the time to buy. I mean, the thing is, you're right. Tina is dead. FOMO isn't dead yet. FOMO will be dead later, but FOMO isn't dead because just look at what's going on now. Everybody is celebrating the birth of a new bull market.
You're right. Maybe FOMO has ingested the rat poison, but is still writhing around on the floor. Doesn't quite have the get up and go it used to have. So maybe FOMO is still with us. So you know what? I want to open this up because we got some
Let
really
me.
smart.
Can I
Sorry, go
just
ahead. Go ahead, Walter. Go ahead. Yours. Go ahead.
I mentioned that ARK was leading on the downside. It topped out in February of 2021. But the fangs didn't top out until much, much later. So it may be that the thing that would frustrate people is if the fangs underperform for a while and the crap just goes sideways. But I suspect that the wringing out of the excesses clearly, 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 ARK has wrung out a lot of the excesses. Whether it's wrung out enough of them, I don't know. But it's wrung out a lot. I mean, the thing hasn't gone down 70% for nothing.
Yeah. No.
But the FANG stocks, are still motherhood and apple pie, and that you just wonder whether the unwinding of the excesses in the FANG stocks might just play out for quite a while.
That would be something. So, Walter, just maybe before we go to some questions, sectorally, is there any dispersion? Anything catch your eye? Like you mentioned that FANG stocks don't look terribly interesting to you on the long side. Are there any sectors that stand out, good or bad to you, that you think might be? Obviously, healthcare has been doing well. Some of the defensive sectors have been doing well. Are those areas that you would still you'd argue for, or someone who wants to put money in the market? Like, what are your picks and pans right now? What do you feel strongly about, good or bad?
Well, traditionally, George, the leading edge of the market that comes out, the two groups that lead that are early leaders are traditionally healthcare and financials. So you keep an eye on them, and they're obviously different financials and stuff like that. And healthcare seems to be doing better than financials. And also, since healthcare does well, then biotech tends to lead the Nasdaq. But whether it's too early to get interested in them or not, I think they're on your watch list certainly.
And leading equipment, I look at the absolutely horrific performance of the financials, and to me, that's a big warning sign. What do you make of the financials yourself, Walter?
They're not doing their traditional early leadership yet. A lot of people are trying to wish them up, but I think it takes time, and maybe they're trying to stabilize, but as I say, financials usually are early leaders, and they're not early leaders yet.
Walter, the advanced decline line, I don't know how much you pay attention to that. That was acting horribly the last month or so. It's bottomed out, it's turned up a little bit, but I guess I'm sort of from Missouri on a lot of this stuff right now. We're kind of betwixt and between. Nothing goes down in a straight line. Not even Enron went down in a straight line. So, like, I totally get what you're saying. ARK was 36, it's now 48 or whatever it is. But, if ARK was to go to a new low, would you be changing your tune?
If ARK started generating relative strength, I would change my tune. I'm not changing my tune. I'm just looking at it as a bellwether.
Yeah, I'm gonna say yeah. So I'm saying, what if this is okay? So let's say ARK turns down. Let's say next thing we know, ARK's down 10 points from here. And it's challenging its recent low. ARK breaks to a new low. Would that? I guess what I'm trying to get at is, Walter, what would it take for you to get more negative on the market? Is my question.
ARK going to new low obviously would be one thing. Just and just more selling pressure than you're getting at the moment. Mm-hmm. If selling pressure, if you get another really bad down day, a 90% downside day where 90% of the volume is in declining stocks, that would be an indication too, I would think.
Got it. All right, let's go to questions now. So I've got a really good bunch of folks up here, and I want to turn to my good friend Shrub. Shrub, good to see you. The floor is yours. Shrub, have a question for Walter?
Hey, George. Hey, Walter. Big
Hey.
fan of Walter, always. So, look, we've had a bit of a bottoming process, like you said, in ARK, and biotech was the same. And it looks like we're doing the same with some FANG stocks like Netflix, Facebook. They're forming like small bases. And obviously, I'm of the school that George was mentioning. The flows that came in are so big to start with that I do think we're going to have a leg down further at some point. I'm also of the view that the worst case scenario, like you said, is a range bound market. So if the Nasdaq stays from 11,000 to 13,000 or 12,500 for a few months, then everyone blows up. So kind of the question is, because I know you look at these periods of bases, and typically in your experience, how long would a base take to form that we can feel comfortably saying, we're ready for liftoff? Because right now we're just seeing some 2-3 month bases, and I've seen enough bases to know that's not really enough to be the start of a new bull market. But just curious to hear your thought.
Well, a base can last as long as you want it to. If you want a clue, there's a website called Deemer Market Memos, deemermarketmemos.com, where all the memos I wrote during my career are posted on a website. So if you want to see what I was thinking in 2001, 2002, 2003, you can go back. I don't know whether I'm going to be terribly embarrassed if you do that or not, but at least it'll show you what I was thinking. But I think, as has been mentioned before, the fact John Roque has pointed out, during the most horrendous, bear market, in the Nasdaq in 2000 to 2003, there are all sorts of counter trend rallies.
Yeah, and in terms of duration for a base, because even I've done enough commodities to see that some bases could last years. So just curious to see that distribution into forming a base. What's the science to see that we're not just in a range bound market and there's like a new there's like a new bull market? Because I see you mentioning sometimes the 90, 85, 90% upside days and all that stuff. So what's kind of your rule of thumb that we're blast off into a new bull market or new trend?
To me, a new bull market is signaled by breakaway momentum, and that's where you get advances 1.97 times declines over a 10-day period. If you Google breakaway momentum, it'll take you to a paper on my website where, among other things, you'll find the 24 times it's been generated since 1945. And the thing is, a lot of people talk a lot about breadth struts. And I would have thought back in May we would have all learned our lesson, because everybody's jumping aboard the 3-day breadth struts we were getting. And the thing is, you get these things all over the place. Sometimes they mean something, sometimes they don't. The only breadth struts I trust are breakaway momentum, which is 10 days, and the Whaley breadth thrust, which is a 5-day breadth thrust. And I mentioned on Twitter last night that you could possibly generate that if you had 2,100 net advances today, which you're obviously not getting. So you're not getting a Whaley breadth thrust. So what you've gotten here so far isn't it. What you do is the market generates awesome power, and when it generates awesome power, that's the beginning of a move, because the biggest overbought happens at the very beginning of a move. So the force of that overbought tells you how strong the move is.
Thank you so much, Walter.
And if you're 10 days late in the bull market, who cares?
Thanks. Hey, Walter, what do you think of energy stocks?
They got overextended. Everybody loved them. Now they've corrected. They'll probably have another leg on the upside, but it may take a while longer to wash out the enthusiasm built up towards them.
So do you think structurally they're still okay?
They're the only thing in an uptrend.
And what would they have to do to show you? I mean, is it just a question that they'd have to fail further for you to become more structurally negative?
Yeah, they'd have to fail further. The only thing I'd mention, though, is I mentioned that healthcare and financials are traditionally the most leading areas of the market. Regrettably, energy is the most lagging area of the market, so that it's correction is not surprising because it's the caboose on the train.
Right.
What so being the last, they have a while.
Got it. That's great. Okay, let's move on. Thanks for that. Let's go to Nitin. Nitin, the floor is yours.
Hi, George. Hi, Walter. Thanks for letting me speak. So, I've been following Walter for quite a time, and he has been very interesting insights. Uh, my question to Walter is do you foresee any kind of black swan event again coming up? Because I do a lot of studies. It's a scientific studies using cycles, technicals, and astrology. Being a financial astrologer, and I've been in March 2020. I've been forecasting about the big event, 24th Fab event. Now I'm seeing another events which is coming from 29 July to 4th of August. We can see some kind of big mayhem is coming between these days. And once Jupiter uh, turns direct later, retrograde in the end of the this month, we will see another kind of sell-off across all asset classes. And especially the third week of August onwards, I see tech stock melting down. So any kind of such events correlate you see coming up in the next 6 months? Because I see the big bottom forming in the markets in 2024, January, February. That time is the where could be a very big bottom of the market is.
Let
Thank you.
me just say that's very interesting. Let me just say that black swans by definition are unpredictable. That they're out there, but you don't know which one it's going to be. And the other is this is a stage in the cycle where they're more likely to appear than other stages.
Okay, cool.
Got
Yeah,
it. Thanks for that, Nitin.
thanks.
Let's go to my good friend Jeff Garbaz. Jeff, the floor is yours. You got a question for Walter, Jeff?
Yeah, I do. So everyone's kind of making a big deal about the 50-day moving average. The S&P went above it 2 days ago. What's your thought process on moving averages?
I think that they're nice to look at, but I don't really pay much attention to them for timing because the thing is that going above a 50-day moving average sometimes it means it's a buy and sometimes it means it's not. So I haven't had a lot of success with moving averages. I just watch them to see whether they're working or not.
So that brings the question then. So what is your favorite? Let's call it trigger tool that you would use within the mix of the technical indicators that are out there. What's your favorite tool?
That's a good question because I don't think I have one because they change from time to time. You can't use oversolds to pick a bottom because the market gets the most oversold at the bottom, but you never know how oversold it's going to be. Divergences sometimes they work, sometimes they don't. So that I kind of look at the more macro view than that. I'm sorry.
So what do you think is not working now in the environment that we're in? What would you avoid? From some of the stuff that you just mentioned? I mean, what would you stay away from?
I've always worked for institutional people, so I never really got involved in the short term. So that I'm not really expert on short term. That I would not get involved in short term breadth thrusts. I would not get involved in just because it breaks a moving average is good. Sometimes divergences are good, and sometimes they're not. So I think the key is when there is a bullish divergence, whether the stock or the market responds to it or not.
Yeah, so this is the last part of the of what's kind of gone on here. So coming into this week, last week 4 of the 5 days were losers, and then after the first 2 days of the week, it was got to 5 to 7, and then we had another up day. But looking back since April, we've only had 3 positive weeks in like the last 15 weeks. And to your point, I agree with you 1,000% about this idea that these couple day moves. I mean, I did a talk with George the other day, and I called it "The more things change, the more they stay the same." I don't see anything different about really what's happened this week than any other time period since we started this in April. Do you? Do you see anything really different that's happened this week compared to the other up weeks we've had?
No, not really. And I think the classic thing was one in May where we got 3 really strong days. We had 3 80% up days in a row, which is very 80% or more of the volume was in advancing stocks. Everybody got all excited, and then the market just fizzled. So that compared to the rally in May, this one arguably is no stronger, and it might be even a little weaker. I would also mention when you say a whole bunch of down weeks that I remember back. I remember back in 1974, and that was the last phase of the 73-74 bear market. And if I remember correctly, the market went down every single day in the month of August, except the final trading day of the month. We all said, well, how can it get worse from here? And then if you look at the chart, September was a disaster. So one of the people I worked with, Tony Tabell, always referred to that as awful August.
Hey, Walter, can you, you got a few years on me. I joined Fidelity as a summer student in 1980, and I can remember the old timers talking about what it was like in the 70s. You come into work every day, you'd expect the market to go down every day. Fidelity was losing money, et cetera, et cetera, et cetera. Could you just explain to us what was the mood like back in the day when things were really bad? Because it's we're all human. If you haven't lived it, it's just sort of an abstract concept. But what was it like that? What was it like coming to work in an environment like that?
It was not fun because you all knew you all, as you say, people came in expecting the market to keep going down. The market kept going down. You're losing your assets at fund managers. I was at Putnam at the time, and fund managers were losing assets all the time. Putnam was losing assets. What happened? We had 2 indicators at Putnam that usually called a bear market bottom. One was the first class plane travel, and you would get a memo saying we've got to cut expenses, so you're no longer allowed to fly first class. You have to fly in the back of the plane from now on. And the other, which was even better, was what we called the human sacrifice indicator. Somebody that was not performing well got fired right at the bottom. And for example, in July of 1970, the market was bottoming, and 2 of the fund managers got fired, and that was the bottom. So the human sacrifice indicator is
sacrifice indicator. So I'm just trying to think right now in current circumstances. I don't know. I mean, no, we're nowhere close to that. Nowhere close to that. Wow.
Yeah, I mean, give you an idea what it was like, and this story was told to me by 2 people who swear it's absolutely true. During the height of the Nifty 50 craze in the early 1970s, when you had the 50 growth stocks going up and everything going down, that John Neff at Windsor Fund, one of the greatest investors ever, came within 1/4 of being fired because of his lousy performance.
Wow. Wow.
Hey, George, I got a quick question. I love hearing these stories like back in the 70s. I was 10 years old, and like you, I kind of started in the 80s. I'm an 86 guy. I would love to hear from Walter how he thinks the buy side has changed from the time he's come into the business to where it's at now. I'm sure he's got a couple, like big concept ideas of what has changed on the buy side and kind of for the better, for the worse. I would love to hear that, being kind of a historian of the market.
I think it's changed for the worse, and that I think that somebody at Fidelity told me some time ago that we now have to we can't deviate from the sector weightings in the indexes by more than 2%. So if you were really, really bullish on energy, you couldn't overweight by more than 2%. Back in the old days, Fidelity was the Wild West. It was fun. It was exciting. And I remember I was at the Contrary Opinion Forum in 1966. I had just started working for Jerry Tsai, who had come from Fidelity, and Mr. Johnson, the first Mr. Johnson, was a speaker. So Jerry wrote me a note of introduction, and I go up there, very young at the end of his presentation, and I'm waiting for the crowd to back away. And somebody asked him, Mr. Johnson, you have 8 or 9 mutual funds now. How do you keep them all on the same track? And Mr. Johnson said, we run Fidelity as close to a complete state of anarchy as possible. That's the way it used to be.
Love that. But by the way, that is so diametrically opposed to Fidelity now. I mean, it is so corporate. It is so buttoned up. It is so don't take any risk. I mean, that's the Fidelity that I grew up at. That's the Fidelity that I love. Yeah. Wow. That's amazing.
And the thing is, I can't speak to the other shops in the street, but I suspect everybody else has done the same thing. They're either, actively prohibited, specifically prohibited from making a big bet, or they're closet indexers.
100%.
In the old days, if you liked energy, you go 25% in energy.
Right.
But now, S&P has a little weight in energy, so you can't go 25% in energy. Too big a bet, too big a risk.
Right. 100%. 100%.
Hey, George, can I ask one last question and then I'll be done?
Yeah.
Okay. Walter, how do you think over since the 70s, the buy side has changed in how they react to earnings? I'd love to hear your thoughts on that. How companies are reacting to earnings from the 70s to where we're at right now.
Well, in the 70s, a company would come out with a lousy earnings report and would sort of go down every day for a couple of weeks and work it into the system. Now it goes down for a couple of seconds. It's instant reaction. I don't have no idea how the market decides that after a bad earnings report comes out that the stock is now worth exactly 12.7% less, and it instantly starts trading there, but it does. So in the old days, you had trends that lasted for weeks. Now you have trends that last for hours.
So Walter, this idea, piling on Jeff's question, this idea nowadays where a company comes out with bad numbers, bad earnings, but they're not as bad as expected. So they're not as bad as the whisper number, and the stock goes up. It's like everyone's gaming the system. Did that sort of thing, like earnings were bad but not as bad as expected, therefore the stock would go up. Would that type of thing happen back in the day, or no? It wasn't that complicated?
It was on a macro basis, because the old saying is in a bull market, stocks don't go down on bad news, and in a bear market, stocks don't go up on good news. So in a bull market, a company would come out with a lousy earnings report and it wouldn't go down. In a bear market, stock would come out with a good earnings report and it wouldn't go up.
Right. Walter,
I will also mention that I took it upon myself to mention about our beloved stock Twitter, that I put out on Twitter that said a conversation between Elon Musk and his accountant. And I said, Elon, this was the day before the earnings came out. Elon, how much did we earn in the quarter? What were our earnings in the last quarter? And the accountant says, what do you want them to be? So Twitter now, Tesla now comes out with earnings 227. So I come back and I go on with the conversation. Eon says, well, how about 227 a share? The accountant says, oh, the only way we can make that number is for you to sell some Bitcoin. And Eon says, so how much do I need to sell?
Right. 100%.
I am a big skeptic of earnings because that they can be anything the company wants them to be.
Yep. Hey, Walter. So Jeff, let me go with it. So Walter, could you please, I've read a lot of your stuff, not all your stuff. I think it'd be helpful. One of the stories would be useful. One of the examples that I love would be helpful for the average investor in the room. Could you explain the difference between a company and a stock, and specifically, I think your story of McDonald's and what happened at Putnam, how the market, had discounted McDonald's, just to set you up, tee it up for you. For everyone who's not familiar, in the early 70s, McDonald's was a tremendous growth stock, sold at a big PE, but didn't mean it was a good stock. So when people like Cathie Woods go running around say buy growth, it's a question of what price. So Walter, could you talk about your story with McDonald's and how that might be instructive for current circumstances?
I can, but before I do, I can let me just say that if you go on Amazon and look up when the time comes to buy, you want to. Amazon gives you a free look in the front of the book. And the last 3 pages of the free look are the story of McDonald's. So it's got the chart and it's also got the memo I wrote. That's but basically, in 1973, McDonald's was selling at 75 times earnings. So one of the great Nifty 50 stocks, selling at like $78 a share. For the next 8 years, earnings per share compounded at 25% per year, compounded for 8 years. They never missed a quarter. And the stock was cut in half, and at the low, it was selling at 8 times earnings. And the bottom line of the story is that Putnam, the Nifty 50 shop, was buying it at 75 times earnings. And I was on Wall Street Week on February 29th of 1980, the only time Wall Street Week was ever broadcast on February 29th. And I wanted to get clearance to mention some of the big growth stocks that I liked them. And I got a reply back. You cannot mention McDonald's because the advisory company manages pension fund money. The advisory company has a sell program in them. So that Putnam was buying it at 75 times earnings and then selling it at 8 times earnings. And the point being is a fundamental analyst in 1973 comes in and says, earnings are going to grow 25% per year compounded for 8 years. What a great company. But you didn't buy the company, you bought the stock, and the stock went down. So the question is, there is a limit to what you pay. This was Cassie's downfall. She obviously, she identified what to her were the greatest, most exciting, most disruptive companies in the world. But she didn't say there is a limit to what price you will pay for that.
100%. And people who, one of the things I really gets my back up, people say, well, I'm buying the company, the valuation doesn't matter. The thing is, when you start paying 50, 100 times earnings, 30 times sales, I mean, you're guaranteed basically law of large numbers that it's going to be a crappy investment. People just don't get that. And that's part of one of the many problems with the democratization of finance, so to speak. Valuation matters. But we've been in this regime where the cost of money is free, valuation hasn't mattered. And so as the cost of capital gets reset, these things get repriced downwards. And unfortunately, I think a lot of people are getting a very expensive lesson. Hey, Walter, I want to ask you about some of my other favorite gems that you've put out. So we'll play a little word game here. So talk about, here's one for you. When the time comes to sell, you won't want to do that either. What did you mean by that?
Well, I was working at Putnam, and I was once upon a time, and the market staged a correction, and unfortunately, I had foreseen the correction, so I didn't make a big deal out of it. I thought it was a correction, but the fund managers, this first day down, next morning they come into my office and say, "Is it time to buy yet?" And I said, "No." Next day, the market goes down some more. They say, "Is it time to buy yet?" And I said, "No." And they kept doing that until I finally wanted to get rid of them. So I said, "When the time comes to buy, you won't want to." You know, which means when the market makes a bottom, one of the quotes I ran across the other day: bear markets do not bottom on good news.
Right. Right. So basically, you have in a bear market, you have to see bad news and just see what the price action is in response to the bad news. Is that what you're saying?
Precisely.
Yeah, and I think
you know,
and you're also familiar with, I don't know if Stan Weinstein invented it or he borrowed it from somebody else, but a line related to that, I'm sure you're familiar with the line. It's not the news that counts, but it's the reaction to the news. Maybe that was Justin.
exactly.
I mean,
precisely. And by the way, that was probably the greatest Twitter space you ever did with Stan.
well, thank you for that, and I hope we'll have Stan back again before too long. And by the way, whatever problems you had with your cell phone, don't worry. Stan was much worse. At least you got that on him. All right, so now we're going to talk about Deemer's law of perversity, the vicious, nasty step beyond contrary opinion. I quote, "The stock market will do whatever it has to do to embarrass the greatest number of people to the greatest extent possible." Could you elaborate on that, Walter?
I don't think it needs that much elaboration. It's just what would frustrate people, and that's why I think if the market if the market stops going down but it doesn't go straight back up, that would frustrate everybody. It seems to me.
There you go.
You get a trading range, and somebody has remarked that trading ranges are horrible to live through because it keeps wanting to go up and then it stops, and then it keeps wanting to go down and then it stops. So they're horrible.
It's funny because I was in the Japanese market in a big way in the 80s, and that's Nice Shrub's been in the market for a while. That was Japan for so many years once we got into a bear market. I mean, it's the bear market in time where there's no trend, and it just chews everybody up, and it's just horrible. And then volume falls away and apathy sets in. That's a bear market. This is not a bear market. That's a bear market. All right, here's another one for you, Walter. And we could update this one. Quote, "Extremely crowded trades rarely work extremely well."
I think that one speaks for itself too. We've all been there and done that.
If we're in 2022, wouldn't we amend that to say extremely crowded Twitter mob recommendations rarely work extremely well? I mean, I kind of noticed, you must too, because Twitter is a great laboratory experiment. It must be funny for you. Wherever you see a Twitter mob, it's sort of like that's the consensus trade. And it may not fail immediately, but if you just put it aside and check back within 30 days, it usually is blown up. So do you get so I'm teeing it up, but do you get using this philosophy about avoiding crowded trades? Do you employ this at all, kind of when you're looking on Twitter? Does Twitter enable you to get a good sense of what consensus is?
Absolutely. And also the institutional surveys. It's like right now I guess the most crowded trade right now is long the dollar.
Yeah,
which of course, it's crazy that to say that the dollar is going to go down at some point, and that some of these other currencies are going to go up. I mean, it boggles the mind, which is why it might just work. It might not work immediately, but there's your crowded trade.
Here's another one for you. Again, it speaks for itself, but I'm actually going to want you to talk a little bit about the man. "The stock market is the creature of man that has most humbled him." And you attributed that to Alan Shaw of Smith Barney. I knew Alan when I was a young'un. Could you talk a little about Alan? What did you learn from him? What was special about Alan?
Alan had some good insights. I didn't work with him quite that closely, but it's funny because in my youth I used to keep point and figure charts on everything on the New York Stock Exchange. It turned out that I think Alan. The point and figure price sheets came out from an outfit called Morgan, Rogers and Roberts over on Broadway in Lower Manhattan, and they came out after the close. And I used to go over there and pick them up so I could do them that night. And Alan says, I was over there too in that office. That we were the only ones there that weren't runners picking up the point and figure sheets.
Hey, Walter, do you still, or did you, or do you still do charts by hand?
No, I don't do charts anymore. I'm retired, so I just watch them on the internet.
Well, back in the day, I mean, we had Helene Meisler in the room recently. She's a friend. And Helene, who, trained at the knee of Justin Mamus, to this day, she insists on charting by hand because it gives her a good feel for what's going on. When you were in business professionally, full time, would you do charts by hand or didn't see a need to?
No, I absolutely did. I agree 100% with her. I think you get a lot more looking at doing a chart by hand because you have to actually think about it when you plot the darn thing rather than just flipping by it on a screen.
Right. No, that's I couldn't agree more. So let's go to a few more questions. I want to bring in my good friend Dave Nikoski, and then we'll go to Guy Cerundolo. Dave, good to see you. What's up, Dave?
Hi, George. How you doing?
Doing well. You got a question for Walter?
I do, Walter. I think one of the things that I'm concerned about in talking about the crowded trade, I completely agree with you, and I've been a technician for almost 30 years. One of the things that I guess I'm concerned about that I don't see other technicians talk about it, and I've discussed it on these calls in the past, is the dollar strength. Everyone obviously crowded trade. In 2002. We had a collapse of the dollar, and it put pressure on the market.
Hey, Dave, we lost you here. Dave? So while we're waiting for Dave to come back, hey, Guy Cerundolo, good to see you, Guy. You there? Go up. Well,
yes.
Dave will come back. Guy, what's up, man? Good to hear from you.
Good to hear from you too, George. I just want to say, Dave's back on. Dave? You could continue if you want. Go ahead.
Dave, you there?
Yeah. Did I get cut off?
Oh yeah, we lost you for a minute.
Okay.
We totally lost.
All right. Somehow my mic got shut off. I'm more concerned about the U.S. dollar if it were to decline. And I'm looking back at 2002. After the internet bubble. We broke the uptrend, and you had a repatriation of funds out of the U.S. to take advantage of much cheaper markets around the world, which sent the emerging markets up significantly. The other question I have that I don't know how to look at it, but you're seeing that Europe can't produce anything. I mean, Romania just shut down an aluminum smelter plant due to the high cost of energy. Nat gas at 7.5 times what the U.S. is. We are taking out players from the market that are contributing product. And with that, you're through that attrition, you're certainly having companies like Alcoa, for instance, is going to be in a better position with much less energy costs associated with them. And again, you're just having attrition in all of the smelter industries. I don't think Germany can produce an automobile at all. In my opinion. Just want to see what your thoughts are on that.
Well, I think that's what I meant. What I meant was I was trying to allude to when I said that the problem is that the market, if the risk in the market is that something breaks, and I would think that something breaks with the currency. From the chatter that I hear, I would suspect maybe it's Japan that trying to keep their bond at 25 basis points, and they're printing money while everybody else is tightening, and that apparently that there's a big carry trade with the yen, and if that blows up, whether it takes a couple hedge funds with them.
Okay.
Thanks. Guy, over to you.
Hey, hi, George. I just want to say first a quick hello to Walter. I don't know if you remember me, but I worked with Bob Hill at Fidelity from 89 to 2002. So we've had many. You hearing your voice is phenomenal. I used to read your letter every week a lot, as well as Stan's and a bunch of other old timers. But God bless. I'm glad you're still around and contributing to our world of technical analysis. But some of the bullet points you made were so spot on. Where talking about moving averages and what's important to investors. I think people should. well, people have to do what they have to do, but your point of avoiding basically the noise and keep focused on the big picture is so important, because even there where I worked with people that are managing anywhere from $1 billion to 50, 60 billion, 70 billion back then, they're moving a battleship in a harbor. So a lot of this noise gyration that people are talking about, whether it be some questions that George may get here or you see on Twitter, it's looking at the trees and not really the forest. So I think where you're coming from is where I came from, and keeping the big picture in mind is always important. So I just want to say thanks for stressing that kind of stuff. One thing I'm curious about, like when I worked at Fidelity, I had 3 computers and then 1 Spark station, and I used machines to help screen and filter through things. And as you know, Mr. Johnson was really high on technology, and not that we threw money around like it was water, but at no expense. That he always provided us with the best technology we had and the resources to even bring in people like you to speak with. So I use machines to kind of filter through things, and some of let's keep it simple. So, show me all stocks that are above a rising 200 day, as an example. So we use machines to filter large baskets to come up with themes and ideas. I'm curious, how did you do it, where you were doing charts maybe by hand? I'm not sure when you went over to computer work, but there's strength in numbers. So one or 2 stocks, as an example, in the semiconductor space that are breaking out, doing well, is not important information unless you see 40-50% of the stocks doing that. So there's strength in numbers. So I'm just curious how you did it back then, and if there's anything you could share with people that would help them now.
I just did it by brute force. That I wasn't into computers and stuff, and I didn't get that much into individual stocks. So, I just looked for things that were interesting. But one of the things I relied very heavily on were the Zawag performance ratings, which I thought were terrific. And unfortunately, that Marty, who is one of the greatest technicians ever, stopped doing it, and it broke my heart when he did, because it was a great source of ideas.
Okay.
So basically what I'm saying is I let Marty do the screening.
Sure. Great. Thanks,
Guy. That's terrific. Let's go now to Michelle. Michelle, you have a question for Walter? The floor is yours. Michelle, please unmute yourself.
Oh, yeah. Thank you, George, and thanks, Walter. So I have a question about I think the Fed, Chris Waller spoke last week, and he talked about after another 75 basis point hike, we're already at a neutral rate. So I think that's probably got market excited. Think we're towards the end of the hike. So if like Fed pause after this month, would that be considered a major pivot? Given
no, Michelle, let me take that question, Walter. No, Michelle, that's, to me, that's just, no, that's not a pivot at all. It's just maybe a pause along the way. And again, a lot of people like to talk aimlessly about the Fed and speculate about the Fed. Nobody knows what the Fed's doing. I don't think the Fed knows what the Fed is doing. And so in these rooms, we generally don't like to talk about the Fed. It's just a complete freaking waste of time. So, and more importantly, from the way I look at it, what's important is not the news, but the reaction to the news. So, yeah, maybe people are using that as an excuse to why they're getting excited now. And that's another thing, too, Walter, I wanted to ask you. It gets to a bigger question. Walter, a lot of people, many people, especially nowadays, and this actually will dovetail with a question Jeff Garbaz asked earlier, they always want to put a reason, or they want to attach meaning to a gyration. They want to have a reason or excuse why the market goes up every day or down every day. And life is not so simple. And I just tend to focus more on what the market is doing, the what, as opposed to the why. Wasn't it the case back in the day that people would try to micro analyze every wiggle and jiggle and try to place meaning on why the market's doing what it's doing? Or is that really more a manifestation of mainstream media and social media nowadays, Walter?
Well, Yeah, I agree. One of the things I said once was ours is not to reason why, ours is just to sell and buy. You know, you don't know the reasons. I mean, somebody comes up with a reason. I always thought the easiest job in the world was to write the evening market comment. The market went up because um, because it was thinking that we were at an inflation peak, or the market went down despite people thinking it was we were at the peak of inflation. You never know why the market's going to do, and frankly, I don't give a crap. It's going to do what it's going to do, and why it does it, you don't know. And I don't think you should really care. One of the other things I have said was, and I apologize to a couple of people on here, but if you want to watch CNBC like the pros do, turn the sound off.
Love it. Love it. Great. That's the best piece of advice all week. Love it. Absolutely love it. All right, let's move on here. So, Nitin, did you have a quick follow-up, Nitin?
Yeah, I wanted to add on the inflationary thing, what you said. So we have
No,
a
no,
Jupiter.
no, 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 nope, 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 nope. That's
Okay,
getting into the why. We're not going to talk about the why. Sorry, not going to allow it.
okay.
All right, let's go to this guy's got the best avatar on in this space today. I want to go to Stan Druck's protege. Stan Druck, what's up?
Yeah, Walter, quick question. With your technical analysis, do you ever look at the non-commercial spec positioning? For instance, right now the SPX, we're talking a negative Z-score of about 2.75, which obviously the market is heavily short the SPX right now. So I'm just wondering if you've ever kind of combined those two analysis.
The answer is yes. I think when we're near an extreme like that, like extremely crowded trades rarely work extremely well, and that the short side got a little too easy for a while, and that I think you'll probably before this is over see everybody go back to a more neutral position, and that will be the end.
Thanks for that, Druck. So, Walter, a couple of more quotes for you. This is Walter Deemer to Walter Deemer. Again, probably requires no elaboration, but if you want to react to it. And I don't know where you got this from. It says Old Wall Street Adage. You wrote, bull markets climb a wall of worry. Bear markets slide down a slope of hope. Doesn't that really kind of describe where we are now?
Yes, sir.
Do you recall where this came from?
No, that's why I couldn't attribute it, because it's just something that everybody seems to say.
Okay, here's another one. Now, I've never heard this one. I've heard this one before, but I don't know who this guy is. So you'll have to explain. So this comes from John Hammerslau of Kaufman-Augsburg. A bull market is when you check your stocks every day to see how much they went up. A bear market is when you don't bother to look anymore.
Yep.
So who is John Hammerslau?
John did a lot of relative strength work for us at Putnam. He did relative strength work on all our portfolios, and his relative strength was required material in the quarterly performance portfolio reviews for the investment policy committee, and so he was mostly involved with that. But he also mentioned that in passing one day, and that I hear a lot of things, and some of them stick with me, and I always try to give credit to whoever said it, because they're a lot smarter than I am.
Yeah. All right, here's an important one, and I think he was one of the great all-time greats, and I don't really know much about him, but we're talking now about Stan Burge, and his daughter still runs their service. Stan was a Tucker Anthony, and your quote here: "Always remember that we are dealing with probabilities and not certainties." Of course, that's where we are. Although that may be lost on some investors when they listen to the charlatans like Cathie Wood, who seem to be pretty certain about everything. But could you talk a little bit about Stan Burge, who he was, what he did, how'd you know him, what'd you learn from him?
As you said, he worked for Tucker Anthony in Providence, and his weekly report was always entitled Providence Market Comments, and I always wondered whether it was coming from Stan or from God when he said Providence. But
yeah, okay.
but Stan probably did more to integrate fundamentals and monetary with technical than with the market than anything else, because he come in with charts and he show a fundamental thing, and then but it would always be overlaid with the market itself. So he taught people a lot about how fundamentals interact with the market.
That's awesome.
Which of course mostly they don't. I mean, the market's a leading economic indicator, so you don't need the market, to tell you. You don't need the economist to tell you what the market's going to do. You need the market to tell the economist what the economy's going to do. He would get into monetary stuff and things like that, but he was one of, I would say, he was one of the all-time biggest influences on me.
Here's one more, and then we'll go to some more questions. This is from Gerald Loeb of E.F. Hutton in 1955. This is one of my favorites. Just when you find the key to the market, they change the locks. Did you know Gerald Loeb, or is this did you ever work with Gerald? Or did you know Gerald?
Didn't know when I was first started in getting interested in the stock market, there weren't a lot of books on it, and Gerald's was one. And actually, the quote was toned down for the book. The quote I prefer is, "Just when you find the key to the stock market, some son of a bitch comes along and changes the lock."
Love it. All right, let's go to some questions. Let's go to Big Al. Hey, Big Al, what's up?
Yes, sir. Thank you guys for putting on this space. I sent you questions via DM, but like, how do institutions, when you guys are running these hedge funds or, main bank funds for Fidelity and what have you, like, how do you pick, buy, sell? Like, are the old school fundamentals still in place for like P ratios? Is it momentum? Is it cyclicals? Are you guys using Bollinger Bands?
Yeah, so Big Al, that's a pretty seemingly simple question. It's a very complicated answer. I think you have to have an integrated approach to investing. I happen to use, of course, you want to find good fundamental stories where the company's getting better, but then you have to look at the valuation, and then you got to look at the technicals, and you have to look at the macroeconomic regime that you're in. So it's not so simple. There is no one size fits all. So it's it sounds like a simple question, but it's a very complicated answer.
Somebody at Fidelity once told me that at Fidelity we use fundamentals to tell us what to buy, and we use technicals to tell us when.
That's very well put, Walter. That's extremely well put. So, Walter, who are some of the other greats that you either worked with or learned from? Because, again, these are people whose names most contemporary investors don't even know ever existed. And I think there's a lot of wisdom that's been lost. And I think you have to understand, I'm so happy you're in this space, because I like hearing your views, but also, more importantly, there's a tremendous amount of wisdom that's been lost. And it's sort of the elders that pass the wisdom down through the ages. And this whole democratization of finance, where people just open up an E-Trade account and away they go, and look at 5-day moving averages or Fibonacci or God knows whatever. It doesn't work that way. You know it, and I know it. And so, Walter, who are some of the greats that you either worked with or maybe you didn't work with, but you learned from? And if they were around today, like, what would they be saying? And what are some of the lessons that stick in your mind that people kind of aren't really as aware as they should be, that things that you would have learned from those that went before you?
Well, before I do the list, and I'll say that Arch Crawford used to work at Merrill Lynch, and he was one of the admitted astrologers on Wall Street. There were a lot of people who used astrology, but they wouldn't admit it. So they'd come up with cycles, but they wouldn't tell them that they were astronomical cycles rather than just mathematical cycles. And Arch and I were trying to come up with an idea, because some of the greats were passing, and Arch being into astrology and stuff. And so what we thought we might do is put out a market letter where we channeled some of the greats that were no longer with us. So like Joe Granville, we could have a discussion with Joe Granville and publish it. And if it turned out wrong, well, you couldn't sue him because he's in heaven or he's in chart room in the sky or whatever.
The
But
chart room in the sky. Love it. Keep going.
the big chart room in the sky. But I would mention Bob Farrell at Merrill Lynch, who I worked for, and he was a big contrarian, and he was big into market psychology and leaning into contrary opinion. And I would mention Marty Zweig, who one of the greats of all time, and he has a book called Winning on Wall Street, and it's kind of out of date, but it's a real classic. And Marty was great because Marty used to share his research, and that he would publish in Barron's, and in the days when Barron's was a must reading on a Saturday, that Marty had a lot of articles in there that were terrific. Stan Burge, we've already mentioned. Edson Gould, I worked very closely with. Jerry Tsai decided to really get closely involved with Edson Gould, so that the people that there were three technicians at Manhattan Fund in those days, and we all spent one afternoon a week down in Edson's office where he was teaching what he knows. Stan Weinstein, of course, that his book is out of date, but it's an old book, but it's still classic. I mean, he had some great things. And I'm also going to mention somebody, George, that I think Bill Doan. He ran the chart room at Fidelity, and it was fun because Bill and Bill Diani from Wellington, who was passed, and I used to get together quite often and swap notes. Such and so just came through town. What do you think of him? Oh, he was a real crazy guy or something. Or so just came through town. What do you think? Oh, he's really interesting and stuff. So we would swap notes, and then of course how the fund managers were harassing us all the time. The fund managers never made mistakes. It was always the technical department or the trading room that made the mistakes. So that Bill Doan and Bill Diani and I would commiserate with each other, and there was a standing joke in those days to run a technical department in a Boston institution. All you needed was the initials WD.
Right. Hey, Guy and or Dave Nikoski, what are your memories of Bill Doan?
Well, I know that him and my father worked very close with each other. And so I worked with my father for many years. I've heard nothing but great things about Bill. I've met him personally a couple of times. Just a great guy. I mean, really understood, technicals. And I, certainly in my discussions with him, I, took away always much better off and much more informed by, how he could read the market.
Yeah. Guy?
Yeah, George. I could comment. So he hired Bob Hill, who hired me at Fidelity. So Bill was involved with the Market Technicians Association, and he would be the person that helped line up and bring in these people that would be vendors of, let's say, technical tools or books or whatever, all these types of things at the forum. And he'd be the one that's always around with the camera taking pictures of all the attendees and stuff like that. So I have great memories of discussion with him. He lived, I believe it was Concord. We got together for lunch every now and then. And he also did a one pager, like a small newsletter. He's a big fan of bases. So similar to like a Steve Shobin, who's another old timer. I'm not sure if he's still alive or not. But John Roque might know because he worked with Shobin way back when. But so for Bill Doan, he's a big base lover. He would always try to highlight stocks that were forming bases that were of a multi-month period. And he was a great guy.
That's awesome.
He was working on a book, and unfortunately he didn't set it up well so that it couldn't be printed. It was called Bill Doan's Big Basis, and his family and some other people are trying to figure out how we can get the darn thing published. But it was Bill Doan's Big Basis, and I'll share one Bill Doan story that Fidelity opened a new chart room, and that they had an open house for the technical people in town. And so we go into the new chart room, and there's Bill Doan's office with a big piece of brown wrapping paper over one chart. And we all wondered what he had covered up. And Dick Cohen, who worked for him, says, I don't know why he covered that one up. That's just his airline chart.
That's awesome. Hey, Walter, you mentioned Joe Granville. Joe Granville is probably a name that's not known to most new investors in the last few years. Did you know Joe Granville? You just knew of him? Could you tell us a little bit about him?
Just knew of him. He was flamboyant. He had a great track record some of the time, and then he sort of flamed out. He wrote a book. A lot of us got involved in technical analysis in the 1960s. He wrote a book called A Daily Strategy for Stock Market Profit, which was absolutely hypnotic, and that most of us started out in technical analysis getting hooked on that book. But we always called him Smoking Joe Granville because either he had a hot track record or he was so crazy he must have been smoking something.
Wait. We're not talking about Kathy. Oh, sorry. No, Joe Granville. Sorry. Okay, let's go to MG. MG, what's up? MG?
Hey, George. Hey, I'm really enjoying this space. I don't have much to contribute except an anecdote that I think you guys might be interested in. And I apologize if it's already been mentioned. But when I was younger, I went to one of these conferences where there was a whole bunch of family office people. A lot of billionaires were around. And someone was mentioning, a lot of, at the time I was a quant, and someone was mentioning a lot of, utilizing astrology and whatnot. And I remember thinking, I was a young guy, kind of hot-headed, very arrogant. What is this bullshit? What are they talking about astrology for? And interestingly enough, this guy turns to me, and I later found out he's like a very, he was a very wealthy guy, he was a billionaire. And he turned to me and he goes, "Young man, I understand that there are no millionaires who believe in astrology, but almost all the billionaires do." And I always remember that story.
That's
I just wanted to kind of include that in here.
I would like to add here that that's a famous quote by J.P. Morgan, that millionaires don't need astrologer, but billionaires do need. So I'm a financial astrologer. I've been doing it successfully for last 20 plus years. And I worked with a large corporate in India. Looking at the chart of the corporate, I left the company because based on my calculation, it was looking like that company is going for a bankruptcy. So yes, it's like astrology is like a language. So
MG, who was the speaker that said that comment to you about astrology, MG?
I don't want to say, but he was a very wealthy billionaire. He was over 60 at the time. So, I don't even know if he's alive now. He would be close to 80 now.
That's great. Appreciate that. All right, let's
go. I'm going to share something for you too, and that is, most people don't know this, but Edson Gould dabbled in astrology. He didn't publicly admit it. Edson Gould was one of the great early technicians.
Right. All right, let's go to Yaba. Yaba?
Yeah, hi. Thanks, George. Walter, I worked with Marty Zweig back in the mid-'80s, that fateful Wall Street week, Friday before Black Monday of '87. And looking now, we've discussed bread thrusts, don't fight the Fed, et cetera. But at the environment that we're in now, would you just take a shot at like maybe some of, and not to specifically focus on Marty, but rest his soul, but some of the most relevant rules that you think are pertinent to the current wacko environment? Because so many aspects have changed from that time, and then so many of the rules stay the same. So I'd just like to get your thoughts on that. Thank you very much.
Well, I would say that Marty's classics, "Don't fight the Fed" and "Don't fight the tape," are every much as applicable now as they ever have been. He uses a bread thrust. I had my own bread thrust that I developed in 1973, so I didn't really pay much attention. They're very similar, but as I say, if you Google breakaway momentum, it'll take you to the piece I wrote on breakaway momentum. he did so much work on indicators, and then bless his heart, he shared them with everybody. That he was monumental.
Yeah, we built the newsletter, and it's funny. It was the rating for the newsletter was a bell curve distribution, and I remember the two. It was written in PL1. I was a programmer, blah 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 at the time, but the two most important. This is really funny. Two most heavily weighted criteria in that were, number one was the value line rating, and number two were earnings surprises. And I think, but the value line rating was the highest, and he made millions and millions and millions with that selling that newsletter.
Yeah, and I happen to think the value line rating includes relative strength. I can never prove it, but it has to.
Absolutely.
That's great. Hey, Walter. Really there aren't a whole lot of technicians on the street anymore, certainly on the sell side. Why do you think that is the case, and what impact has that had on market structure? Does it make it easier for you now because there are fewer technicians out there, or does it make it more difficult because fewer people are following the quote unquote, rules of the road? I mean, so speak to why. So first question, why are there so few technicians on the sell side now, Walter?
Because all the money managers think they're technicians, and a couple of them are good ones, like Mike, who is on here, but most of them aren't. They just think they are, so they don't think they need sell side research.
Got it. Hey, Aces, you've been pretty quiet. You have any questions for Walter?
Yeah. Hi, Walter. Nice to meet you. Excuse me. Thanks, George. Walter, the things that come to mind for me, from when I first started doing this stuff 30 some odd years ago is, the nature of the market is just so different today. I mean, when I started, I think we had, many thousands more stocks than are publicly traded than today, given all the mergers and acquisitions and so on and so forth. When I started, not everything was tech, right? I mean, when I look at the quote unquote markets now, it's almost like, what Wall Street and Silicon Valley did in this last cycle was they figured out a trick, call everything a tech stock and give it a tech multiple. I mean, look at Tesla, look at Beyond Meat, look at Wayfair, which is a furniture retailer, look at Carvana, which is a used car sales company. They're all tech stocks with tech multiples. And then you have this, what almost looks to be permanent capital in the ETFs and in the 401ks and stuff. And I'm just curious, do you think that these kinds of things may have had a role or a tendency to distort, what us old school price discovery guys, used to think, was the market, or it's all just the efficient market hypothesis, and it just is what it is. Thank you very much for your time.
Thanks. I would just I would just say that I don't think there's an efficient market. I don't think there is any efficient market. I don't think there's any permanent money in ETFs. One of the big worries that people have is that something's going to someday something's going to happen that want investors want the public to take their money out of the ETFs rather than keep putting it in. So I don't think it's changed that much. But I mean, Wall Street has always been good at putting lipstick on pigs, and then you just mentioned a couple of pigs that have lipstick on them.
Yeah, it's just it's always like the fashion business. A couple names that come to I just thought of. One of the listeners threw out he threw one name at me, and two more came to mind. Did you know Ralph Bloch?
Not well.
Okay. How about Ralph Acampora?
Know him fairly well.
And John Mendelsohn?
Knew him. Worked very closely with him.
Could you talk at all about what Ralph Acampora or John Mendelsohn were noted for, or what
Well,
they did?
I don't want to get into Ralph too much, but most people think he's more of a contrary indicator than anything else, and I'm not sure whether that's correct or not. But that's sort of the reputation.
Yeah.
And John Mendelsohn, he had some very interesting things, and he wrote. He had probably the first X-rated market letter that I know of. He had a diaper indicator and stuff like that. He said that.
Okay. Yeah.
Yeah, he said when the market's going down, and then all of a sudden people started buying diapers, everybody got excited and they started buying diapers, and that was getting near the bottom.
That's funny. That's Ralph Acampora. That was
Ralph was. I didn't really work that closely with Ralph.
Okay, I got it. That's fine. Awesome. So we're going to go to Phoenix Fire. Hold on a second here. Speaker. So Phoenix is coming up to stage. Again, we're speaking with Walter Deemer. Walter, how many years were you in the business? 50-odd years? How many years was your career, Walter?
Started working in 1963 from Roland. Started following the stock market more closely in 1961.
Wow, that's awesome. Hey, Phoenix, you got a question for Walter? Phoenix,
Hi.
unmute yourself, please.
Yep. Hi, can you hear me?
Yeah, we got it.
Thank you very much for this. I just wanted to get your insights on how similar today's environment is to Nifty 50s, and if you could really describe to us when the Nifty 50s collapsed, since you lived through that, and what lessons we could take from that.
Well, the Nifty 50 really didn't collapse so much. It's just, they got too high and then they started down, and then they kept eroding away for year after year after year. That the multiples were high, and then they started eroding, and McDonald's was 75 times earnings, then it was 50 times earnings, then it was 40 times earnings, then it was 30 times earnings, and so on. And it was sandpaper. And the reason Putnam was selling McDonald's at 8 times earnings was because it was underperforming. So it's a long, drawn out process. You get a period of great. It was a very crowded trade. It was the only thing that was working, and it just took years to unwind.
And is there
and I will say that the similarities between the FANG stocks and the Nifty 50 stocks are too glaring to ignore.
That's really interesting. By the way, I see there are a couple of people who raise their hand and want to speak. If I don't know you and I haven't put you up on stage, please send me a direct message with your question. I'm trying to limit the scope of the questions. Walter, I have a question from another listener. Did you know a Harry Laubscher? He was a chartist at PaineWebber?
Didn't know him well.
Didn't know him well. Okay.
I knew everybody because I was a founding member of the MTA. So that and we ran the admissions thing out of Putnam and Boston. So when they came into the MTA, their application crossed my desk.
Yeah. Hey, but another question, Walter. What do you make of Elliott Wave? And did you know Robert Prechter?
I knew Bob Prechter very well. Bob is a big early rock and roll enthusiast, as I am, as Marty Zweig was, and as Stan Weinstein is. And we used to have fun at the MTA meetings, the seminars. We get together afterwards in the bar, and we start, talking about, quizzing each other about early rock and roll. But my thing on Elliott, I lost all interest in Elliott Wave. I think it's great in hindsight, but I was at a conference one time. Some guy spends 10 minutes, working out this Elliott Wave pattern and everything like that, and it's bullish. And that's how I go through all that. And he says, but now let me tell you about the alternate account. And he spends another 10 minutes going through another account that's bearish. And I said, what the hell good is this?
So that leads to the question. I'm sorry. I don't think Thornton's in the room, so I can ask it. What do you make of DeMark?
He seems I don't understand it, but he seems to be an absolute genius.
Okay, you answered the question. I'm not going to press it. I understand you. Okay, another question from another listener. did you ever work or did you know a George Lindsay?
Knew of him, didn't know him well, but he was viewed generally as sort of being on the fringe, but he was right a lot more often than he was wrong.
So you didn't read. So the question was, if you had a view on his book, did you read his book?
No, I did not.
Okay. And then one of the Bibles of that people frequently refer to. What's your take on Edwards and McGee?
Well, number one, that somebody took it over after about the sixth edition. So the later editions are not pure Edwards and McGee. If you want to do Edwards and McGee, make sure you get an old copy that's Edwards and McGee and doesn't have some other guy editing it or something like that. I kind of prefer Bill Giler's book, Jiler. He ran Trendlines, which we all subscribed to back in the day. And he wrote a book about how charts can help you in the stock market. And I think it's a much better explanation of what's going on.
You said Bill Giler, just for the people in the room, Jailer. Is that right?
No, Jiler. Bill Jiler.
Okay, all right, that's extremely helpful. And then I want to ask you about Justin Mamus and then his disciple Stan Weinstein. Stan's still around. Did you know those guys and your take?
Yeah, knew Justin well and know Helene well, and I think they're both brilliant.
Right, got it. How about Tom McClellan?
Know him well. He does some amazing work. The only caveat I have was I'm a hedge fund manager in Los Angeles once told me the only thing you got to be careful with Tom is he tries to correlate strange things together, and that I don't always understand the correlation, but the pure technical work is just awesome.
Right. Did you ever know a guy? I didn't overlap. I was overlapped with him, but I've never heard of him, and he's got quite a Twitter following. And I think he's really kind of wrong way Louie. Did you ever know a guy, David Hunter from Fidelity?
Did not.
Okay, that's fair. That's fair. And how about Ian Notley and John Brooks?
Ian Notley was I loved his stuff, and it took us a while because he had curves that he had a great machine in the old days that were displayed charts with timing curves, and he wouldn't tell us anybody what they were, and somebody finally much later figured out they were Kopik curves on various time frames. But he did wonderful stuff.
Are you maybe you could explain? Do you have time for Kopik curves? Is that something you pay attention to?
Not really, but I think it's basically comparing an 11-month moving average to a 14-month moving average. So it's a long-term timing signals.
Right. Hey, slightly different question. How has and again, this is probably going to get more into the why as opposed to the what, but the narrative, not the narrative. Ever since the Fed's been so active in markets, pumping so much money into the markets, it's changed the character of the markets, the nature of the markets. It kind of reminds you of we're all, when we were kids and we played pinball machines back in the day, we had mechanical pinball machines. If you didn't like the way the ball was rolling, you kind of picked it up and tilted it or banged it or whatever. And that's kind of, to my way of thinking, what the Fed has done with markets. Has the composition of the markets, the way the Fed's been manipulating things or been so active with their monetary policy, has that changed the way you look at markets or the way you do your analysis?
Well, I think the Fed changes the underlying name of the game. I mean, the fact that they were pumping money into the economy was obviously one of the things that made the market go up. So, don't fight the Fed.
Don't fight the Fed. Yeah, no, that's for darn sure. All right. Well, listen, Walter, this has been absolutely phenomenal. I can't thank you enough for this.
Can I just please one thing about not fighting the Fed? The Fed apparently was happy to have two things. If two things happened, number one, if the stock market went down, and number two, if the housing prices went down, and I think they're getting their wish on both sides.
Exactly.
So don't fight the Fed.
Yeah, exactly. What could possibly go wrong? Listen, this has been phenomenal. Walter, I really, truly hope you'll come back. This has been phenomenal. Your voice needs to be heard in the public square. There's just so much, those who've gone before us have the greats, the true greats, and unfortunately, their messages have been getting drowned out by social media and not participating in as such. And I'm glad that you're now you're a Twitter groupie, which is awesome. And we had Stan Weinstein in here a few months ago. I remember you said you listened to Space, really liked it. We had Dennis Gartman. Dave Nikoski's been in here. Guy's been in here. John Roque. A lot of the chartists. Jeff Garbaz. Just the list goes on and on and on. And I think you're helping so many people, Walter. You may not realize it, but passing on the tradition of the greats that went before us, your message needs to be heard. I urge everyone to follow Walter. Also, he's got a book. Again, I'm not getting any kickbacks here, but it's a brilliant little delightful read. It's on Amazon. It's got a lot of quotes, and you'll sound smart when you're in a cocktail party talking stocks with other people. And so I frequently tweet out your quotes. People are like, "Ooh, that sounds nice." And by the way, again, if anyone's interested, I put a slide deck together recently on various charts that are of interest to me. Please contact me, DM me, but send me your email address so I can send it to you if you're interested. So with that, Walter, again, I want to thank you. This has been awesome. Thank you, Dave Nikoski. Thanks, Guy Sarandulo. Thanks, Shrub. Thanks, Three Aces, and all the others. This has been terrific. And we'll see you again next week. Thanks, everybody.
Thanks, George.
Take care, Walter. Bye.